Right, good afternoon and welcome everybody to this week's weekly education session for Wednesday 27th of May 2015. David here with your once a week education session, remembering they are on every Wednesday at 4 till 5 p.m. Usually taking somewhere between about half an hour and an hour, depending on how carried away I get or how enthusiastic I get. Let's get into it today. You've all received the invitation. Today's topic is on relative strength comparison. So before we get too far down the track, we must give first and foremost our disclaimers, which basically states that the content of today's presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investing objectives, financial situation, or particular needs. So before making an investing decision based on the general advice presented in any of the Elite Wealth presentations, please consider whether the advice is appropriate in light of your financial circumstances. Alright, today our topics are the relative strength comparison. What is it? How does it work? And why is it so valuable? I'm also going to talk a little bit about what is referred to as absolute relative strength, so what that means, and again why that's important to us, and the concept of momentum. We often hear about momentum either when we're at school learning a little bit about physics, or momentum in nature as well. So what's behind momentum, and what do some of the studies suggest about the importance of momentum as well, and then we'll have a little bit of a recap at the end. So let's get stuck into it. Relative strength comparison. Now, you all should know by now that in your Beyond charts that we have a series of indicators called the relative strength comparison. And the beauty about these relative strength comparison indicators is that it gives us a measure of how each stock is performing relative to its benchmark. So we've got three different colours, the red, the blue and the green, and they basically represent three different time frames. So when we bring up these indicators on Beyond charts, the histograms will either be pointing upwards or they'll be pointing downwards. Now if the histograms are pointing upwards, it means that for that particular time frame the stock is outperforming the index, the benchmark. So in this case, in the Australian market, our benchmark is the ASX 200 or the XJO. The benchmark in the US, in the past we've either used the S&P 500 or the S&P 1500, which gives us a slightly broader cross-section, if you like, on which to compare. So we have three different time frames. The red time frame, the shorter period time frame, is representing the last 21 periods. So what it's doing is it's comparing the strength of the individual stock that you are looking at against the 21 period moving average of the benchmark, in this case the ASX 200. The blue histogram represents a comparison between the stock that you're looking at and the 63 period moving average of it compared to the 63 period moving average of the benchmark. So if this, as an example, if the stock is outperforming, then the histograms will be pointing upwards, as you can see on the chart there, meaning that in this case not only is it outperforming in a shorter term time frame, say shorter term being 21 periods, it's also outperforming the benchmark index on the medium term, that is the 63 period time frame. The green down the bottom there is a longer term time frame. So in this particular example we're comparing the strength of the individual stock, in this case over its last 125 periods, with the performance of the index over the last 125 periods. So we're really comparing how the stock is performing in three time frames. Now what you will remember from probably your first introduction to Elite Wealth through the Trading Plan Plus workshops was that our best results, or our highest probability trades, are when we're trading in alignment with not just the short-term trend but also including the medium-term trend and also the long-term trend. So the relative strength is giving us an indication on how our stock is performing over those three time frames and whether or not it's actually beating the index. So if you like to think of it, it's a little bit like ripples, waves, and the tide. So we're starting off with a shorter term time frame there, representing the 21 period. They can be, another way of looking at that is they're ripples on the ocean. And then as the medium term comes into play and starts to outperform, we start to get waves forming, and then when we get the longer term as well, all going in the same direction, then that's basically representing the tide. So the best time to go surfing and catch some waves is when the ripples are going in the same direction as the waves, and the waves are going in the same direction as the tide. It's a fairly simple analogy or metaphor, but it's a really important concept, and it's a concept that a lot of mum and dad investors are quite unaware of. The next concept I wanted to discuss before we go in and have a look at an actual case study, or a number of case studies, is what's called absolute relative strength. So we were just talking about how an individual stock was performing against its benchmark, whether it was beating the benchmark or not. Absolute relative strength refers to the individual stock. And this is an important concept because what we're looking for are stocks that are not only beating the market, but also beating themselves, if that sounds possible. So what I mean by that is that stocks that are experiencing an increasing rate of change. Okay, so not only are they beating and outperforming the market, but they themselves are starting to accelerate as well. So their rate of change is actually increasing. A little bit like your teenagers at home. For a while there, they don't do too much, and then by the time they get to 14, 15, 16, they really put on a growth spurt and show, what we call absolute relative strength. So again, a similar sort of metaphor, for want of a better description. So what absolute relative strength is doing is it's comparing how that stock is performing from the last period back to the second last period. Okay, so whatever period you're looking at, doesn't matter whether it's a day or whether it's a week or a month, we can get a clear indication of whether that stock is speeding up relative to its mean or its average movement, if you like. And then what we can do is we can also then overlay that to the benchmark and see how it's performing against the benchmark. Because at the end of the day, what we're wanting to do is to try and find those best stocks in the market. And how do we do that? How do we find those stocks that have a reasonable opportunity of going on to produce some really good returns for us? Alright, so let's go through and to illustrate a couple of points here, particularly to do with relative strength. We're going to go through and have a look at a stock which hopefully you've had a piece of over the last probably 3 or 4 years, is Ramsay Health Care. Now there's certainly, this is one that really sticks out, and it's a stock that's outperformed the benchmark by a long way. And you only need a couple of these sorts of stocks in your portfolio, and it makes a massive difference to the final outcomes. So let's go through and have a look at Ramsay Health Care. So what I'll do is I'm just going to jump into Beyond Charts now, and I've got a chart here of Ramsay Health Care, and you'll see this. What I'm doing here is just giving you an example, not so much from recent times, but what was happening with Ramsay Health Care during a time frame when the market was going down. So 2008 we had our GFC. It'd be interesting to see how Ramsay was performing at that particular time. Now, just to describe what I've got on my chart here, this pink line is basically the performance of the XJO, so our benchmark index. Okay, so we can see during the GFC, the benchmark was certainly traveling primarily in one direction. It had some massive moves down, some big swings up, and some massive moves down again. It was a really volatile time in the market. And one of the things to note is a lot of people will say, well, you can't time the market and you don't know, you have to be in there, because if you're not in there, then you're going to miss the biggest up days. What they fail to realise is that the biggest up days that the market has ever had were in the middle of the GFC. So I'm not too sure whether I really want to be in stocks when the entire world was pointing in one direction, just to be in stock so I could get the biggest up days whilst the rest of the world was falling down. It doesn't make sense to me. Anyway, this the pink line is the performance of the XJO, and it's comparing the if you like, the historical performance of Ramsay Health Care, which is this black line across the bottom. So I've managed to get both entities on the same chart, and they're just represented as a line chart in this particular example. So the first thing that we note is that we've got the XJO, which is over a period of time is deteriorating. Now, whilst the XJO was plummeting through here, we can see that Ramsay itself was fairly much going sideways. So in other words, the stock was holding up in comparison to the benchmark. So you'll see through here that our relative strength comparisons are above zero, meaning that the stock is outperforming. The way that this stock was really outperforming was that it really just wasn't going backwards. The rest of the market was, but the stock was pretty much holding firm. So that's an indication of relative strength. Okay, there's another example a little bit further along, and we see that the stock really starts to weaken. Now, how is its performance compared to the rest of the index? Well, at this particular time, the XJO was going down, and we might think, well, our stock's going down too. Is it going down as fast as the XJO, or is it actually going down faster? Because that's important as well. So in this particular time frame, we can see that our stock is deteriorating. So is the XJO, our benchmark. But unfortunately, on this occasion, our stock is deteriorating at a much quicker rate than what the benchmark is. So here, our relative strength comparison is dipping to the negative side. It's underperforming the benchmark, and it's underperforming in all three time frames. So this is something to be monitoring in your own portfolio, whether or not your stock is actually going backwards compared to the index. As the market continues to deteriorate, our stock continues to weaken. So we had a period of certainly strong weakening, if that makes sense, through here. We had a little bit of a pause in that weakening, and then it started to deteriorate once more. So again, we need to think about what's happening in the broader market at this point in time. Well, what our relative strength comparison is telling us that at this point in time, even though our stock was weakening, it was still outperforming the broader market, the benchmark, in this particular time frame. So again, showing good relative strength when compared to what the rest of the market is doing. So this is one of the things that we're looking for when we're looking to establish whether it's a short-term portfolio or a medium to longer-term portfolio, that we're going to populate our portfolio with stocks that are going to hold up well when the market's deteriorating. And at the same time, when the market starts to move along, that it doesn't just match the market performance, because we want to beat the market, but in fact it outperforms. And so how do we get to know that? Well, the beauty of your Beyond Chart scans is that it helps us to identify a collection of stocks that are doing that. It doesn't tell us which ones are going to be the ones that stay in our portfolio for the next 6 months, 12 months, 18 months, 2 years, but it points us in the right direction, and it's a big head start on the mums and dads out there, the normal retail investors that really don't have too much of a clue about the importance of relative strength. You'll see over a period of time that eventually the XJO starts to improve. This was around about March 2009, which was pretty much the end of the GFC in terms of the impact on the financial markets, and the Australian index actually started to improve quite quickly. During this particular time, Ramsay itself, the stock started to stabilise. Okay, now it was stabilising, but our market had a very big recovery from the depths of 2009 in March right through 2009. Our market recovered really quickly, and during this particular time, Ramsay, whilst holding up and going sideways, which is not necessarily a bad thing, when we compare it with what was happening in the broader market, it was underperforming. Alright, so certainly not a stock that would be too interested in its performance, given that the market is racing up the hill and we're being left behind. As we go through a little bit further on, our market recovers and then we start to go sideways for a period of time. It was at that point when our market was starting to stabilize and drift sideways that Ramsay started to put on some performance. And you can see from around about February of 2010, once the market got interested in this stock, it really started to chug along very, very nicely, whilst the broader market was essentially going sideways. So again, our stock is now starting to outperform, and this is the time that it's going to appear on our scans. It's certainly not going to appear on our scans when it's underperforming. Alright, so that's something to keep in mind always. Okay, so we're not just trawling the market looking for a bite of any old fish that's going to poke its head up. We're really looking for one that's got some fight in it for us. And this particular stock has a history of outperforming for a considerable period of time, and you can see that through the relative strength comparison. And it remains comparatively strong from that 2010 period pretty much all the way through to now, and it's outperformed the benchmark by a massive amount. So what we might do is go through and just with my analysis go through and have a little bit of a look at some examples of what this actually means. So I'll pop this analysis on. Okay, so these little green dots that we've got on the chart here are just signals, and you can see there highlighted it says ASX daily loose plus confirming. That actually should be the weekly confirming one, so I'm going to pop that one on. And you'll see that this pops up at various opportunities along the way. Now you might remember that all we want to do with our scans once we've created a shortlist is overlay our price action filter. So we're really looking for opportunities where we've got the best price action possible. Now this is primarily for the benefit of newer traders, perhaps through to intermediate traders. Those of you who've been in the markets for a significant period of time now would know through experience that there are different ways to enter a trade. Now I'm not going to talk about those today because it's off the topic. However, there has been plenty of opportunities in Ramsay, depending on your risk profile, to make lots of clearly structured trades throughout its history. Now if we just go back in time for a little bit, a couple of examples through here. Now on this particular chart, obviously we've got the relative strength indicators, which we know so well, and down the bottom here this is just simply a rate of change indicator, which you've all got on your Beyond charts. Now what the rate of change is doing is it's just telling me in regards to the stock itself how it's performing. Is its own performance increasing? Okay, we know that it's performing better compared to the index, but is its own performance increasing as well? So this is the concept of absolute relative strength. So absolute relative strength and comparative relative strength are teaming up together to what I call, or put under a nutshell if you like, that of momentum. Alright, so momentum is something that is certainly prevalent not just in nature, but it's very prevalent in the financial markets. And one of the things that you'll notice in the financial markets is that because of momentum, the markets often overshoot, and they do it on the upside and they also do it on the downside. So it's something to keep in mind. But once momentum, once inertia has become overcome, if you like, for want of a better word, once momentum is underway and we've got past that initial inertia, it doesn't take a lot of energy to keep the stock moving. So you might remember again back to your Trading Plan Plus workshops the concept of volume, that stocks can actually continue to rise on very low volume, and they do that because nobody wants to sell. So there's not nearly as much stock available. If you want a piece of it, you're going to have to pay a higher and higher price. So stocks can actually rise on low volume. So what we've got here, we've got a duplicity, if you like, in that the stock is not just outperforming the index, but itself it's improving its performance as well. So we've got what we call dual momentum. And you'll see through these particular time frames where the stock really starts to motor along. Now, nothing goes up in a straight line forever, and certainly there are going to be times when stocks pause. And you'll see through here that during this particular time frame here, on the short-term basis, it started to underperform the benchmark just a little bit. So a couple of histograms pointing to the downward side. Certainly in terms of our waves and our tide, still massively outperforming the benchmark. Its rate of change, you'll see here, also started to slow down a little bit as well as it was resting. Typically what the market does, and you'll see this in a number of stocks, is it'll push the market up quite quickly for a while, and then the market will tend to lose interest because the guys who are moving the market, the big fund managers, are not willing to pay more and more until they've got a little bit more evidence perhaps that the fundamentals justify the current price. So prices will go up for a period of time and then they might stagnate or drift sideways. And it's not unusual when a stock is drifting sideways, depending on what's happening to the market, to show a little bit of weakness along the way. Now you've got to remember that when we're investing for the medium to longer term, this is going to happen in a lot of our trades. We're going to get some sideways movement. So the sort of thing here that you're looking for, obviously we've got a trailing stop in here that we use along the way to give the stock lots of room to move. And the benefit of that is that it enables us to get some really significant moves, which is really going to help build our portfolio. So after a resting phase through here, the stock starts to increase again in relative strength. Its rate of change starts to pick up. So what this is really tracking, if you like, is money flow into the stock. Now, if there's money flowing into the stock, that's a great thing if we're already a holder of this stock, but it's also a great thing to know if we're looking to purchase. All right, so again, just by using our simple price action filters along the way, you can probably see that there's some opportunities through here where we've got formations of higher troughs as examples, well clear of previous peak levels. So there's a number of examples throughout the market where we've had those sorts of opportunities, not just in Ramsay Health Care. Some of the other stocks that I just wanted to go through and have a little bit of a closer look at as part of the exercise. I've got a list of probably about half a dozen of them. One of them was CSL. So we'll bring CSL up here as an example. Now again, this is a stock probably a few more mums and dads might know about. And probably more than likely the way that they've got to learn about this stock is they bought it during the float and they've probably hung on ever since. And in this case they've been fortunate enough that the stock's actually performed and it hasn't found its way into the sock jaw. So same sort of comparison here with the index. Back in 2012, this is a weekly chart, and using our price action model, the first thing you should be aware of is the relative strength comparison. It's outperforming in all three timeframes. This is what your scans do. They look for stocks that are outperforming the benchmark short, medium and long term. Then your job is to, from that list that is created, is to go through and apply your price action filter. In the simplest sense of it, is making sure that the last trough that is formed is at or above the second from last peak, which is the one over here. Okay. Now I'm not talking about aggressive entries or anything like that. I'm being very, very conservative and just showing that the examples here where we've got really good, strong relative strength comparison is certainly a big feather in this stock's cap. Now through this particular time, you'll see that when the stock's having a little bit of a retracement, a little bit of a pause, that its rate of change declines a little bit. Overall though, our rate of change is gradually increasing along the way. That coupled with really strong relative strength is pushing the stock onwards and upwards. So your job really becomes a whole lot easier when you've got a scan that helps to find at least a collection of stocks that you can filter through, sift through if you like, so you're not quite looking for a needle in a haystack. It's more a needle in a hay bale, maybe, as an example. So what you're really doing there is then using your understanding of price action, doing your position sizing accordingly, understanding what the level of market risk is at that point, and just being patient along the way. Now here's a tip, a very, very simple method of trailing your stop. We've discussed this in the education sessions before, the concept of using a trailing 3 ATR stop. And as the price moves upwards, it eventually drags the 3 ATR upwards as well. It gives it plenty of room to move around, and if we stay in the stock until price closes below the 3 ATR, in this particular example we had to wait 2 years. I don't think that worries anyone too much, waiting 2 years, providing your stock's going in the right direction. So in this particular example, the price went from nearly $40 to around about $63, $64. So it's a $23 move, which represents nearly 60% over the course of 2 years, which on an annualized basis is around about 25%. It's a pretty good return in anyone's language, and if you had that sort of a return on your house as an investment, you'd be jumping over the moon. So I think this is a terrific outcome from a really basic buy, be patient, you've got your rules when to get out along the way, strategy to use. So that's CSL, and that's an example of one that you could certainly be in a couple of times. We got stopped out, so what do? Well, we keep running our scans on a weekly basis and we look for another opportunity. When an opportunity comes through, we're going to have relative strength better than the index. The fact that these histogram bars are getting higher is also telling us that it's outperforming the benchmark at an increasing rate. Okay, now that may well be that the benchmark during that time is deteriorating. That could be one reason, but we're also seeing that its rate of change through here, the stock's rate of change, how quickly it's performing, is increasing as well. So we've got that dual momentum effect occurring again, and you can see what happens, that through this pausing bit it really starts to kick off again along the way. Don't forget, you've got price volume volatility signals along the way, so there are opportunities when they go off, depending on where you've entered, to make a call and choose whether you want to liquidate some of your position. Now the benefit obviously of doing that, as an example here, we've got a price volume volatility signal that's gone off. We've been in the trade for about 160 days, so about 4 months roughly, and we've got a 23% return so far. So things are going along pretty well in this stock, particularly when you think about, well, what has our market done in the last 4 or 5 months, as an example. Hasn't done a hell of a lot during that particular time, so this has really outperformed. So you can see that again, not just through the relative strength, but in actual price movements as well. So at this point, if you wanted to sell half your holdings, certainly you could. If you felt that 23% was sufficient in a third of a year, then you could sell half your position and wait for the next setup opportunity. If price does happen to come down and stop you out, then that would mean that price has actually reversed 3 ATRs, coming down to our 3 ATR trailing stop to stop you out. That's quite a distance. Now if it happens to do that and stop us out down at this level, then we're still going to make a little bit of money. We might make 10% on the stock, and getting in at $75 and out at about 83. That's around about 10%. So if we did happen to get out down at a lower level, then we're making 10% on half the trade, we're making 23 on the other half, so we split the difference and we're getting an average there of somewhere around about probably about 16% return in the space of about 4 months. So a good result from CSL, and a couple of opportunities along the way. Another example, Flight Centre, again 2012. If you cast your mind back to 2011 was a pretty terrible year on our markets. In fact, half of 2010 and 11 was very much in a wide-ranging sideways pattern. We had the Eurozone crisis occurring, all sorts of things going on there. So running our scans, the first thing you'll notice, the relative strength comes through loud and clear. The individual rate of change for the stock has been increasing through this particular time frame. We look at our price action, keeping it really, really simple, very conservative entries. And your job is then just to follow the trailing stop, get out when price closes below. Now in this particular example, price closed down on this particular day here. It actually closed. So I'll just bring up the value line there and show you that it closed. So the close on that day was 46.90 and our trailing 3 ATR stop was $46.86. So at the end of the week, Monday morning, our job is to go to the market and sell our position. So I'll just move that out of the way. So in doing so, getting out at this particular level, we've had a $20 move in the price of the stop, nearly $21, which represents a move of 82%. That occurred in, what's that? That's not quite 2 years, but over that space of time, it represents a per annum return of 37.6. So this is the sort of thing that, as I say, it's not just because you get a setup that has these three things going for it doesn't mean that it's going to go all this far. What you need to do is just be consistent and patient and allow the trades to evolve. Now the trade might have triggered in and turned around and stopped us out within the space of a couple of weeks. Well, guess what? That's just the markets, and that's just trading. That's why we define our risk, accept it. Otherwise we don't step foot in the market. So that's Flight Centre. A couple of other examples here. Magellan Flagship Fund. Another sort of example where through a period of slowing down performance, if you like, through here, we actually had an opportunity where our trade set up in terms of structure quite nicely, in terms of we have a trough which is clearly above the second from last peak. Our relative strength, whilst it was on the decline on the short term, through this particular period here, started to increase. Okay, and that's a good thing. So we've got relative strength starting to increase in the 3 time frames. We're using our price action, just taking an entry, and what happened? Well, for a period of time, the price triggered us in, went sideways, went up a little bit. Price came down towards our 3 ATR. Now remember, our trade management, we get out when price closes below. Well, price didn't close below. Okay, if it did, we'd have a big black candle poking through the bottom of the green line. Price continued on its merry way. We had a price volume volatility signal go off. At that point, we'd have been in the trade for 175 days. Price had moved from 90 cents to $1.23, representing 36% return in pretty quick time. So that's an annualized rate of about 90%. These are great figures. So if at that point you thought, well, I've made a reasonable amount on that, certainly nothing the matter with selling half your holding. Okay, just be patient, see what happens. These price volume volatility signals can signal a turnaround in the market. It'd be a shame to have held onto a position doing really, really well, only to be stopped out and giving, 2/3 or 3/4 of that back to the market. You don't need to do that. Price continues up and then starts to go sideways a bit, and you'll see that relative to the market, at least in the short term, that it starts to weaken. Okay, things don't go up in a straight line. They're going to pause. The market needs to think about it, and then it started to move up once more. We get another couple of price volume volatility signals going off, and at this point we're up. The change in price is nearly 72%. Okay, so we've still made some very good money on the other half of the trade. So if we've made 72% and we wanted to take the other half off, we could certainly do that. No problems with that, and you're going to end up with a trade result which is the average of those two, which is still going to be a terrific outcome. Or alternatively, you can just wait until price closes below our trailing 3 ATR stop, which is on that one there. And then what we can do, with a little bit of luck, pop that over, if it's going to move for me, down near enough to there, and our initial entry was back there, and it's a bit hard to see with all that on there, so I'll take the first one off. There we go. And just by trailing and exiting when price closes below our 3 ATR, we were in it for about a year and a half and we made 57%. That's still pretty good money in light of what's happened in the rest of the market. So certainly I think there's a lot of value in understanding not just relative strength in terms of identifying opportunities for you, but keeping your trade management nice and simple. I think they were the main ones that I had as examples. I'll also bring up this one too, corporate travel. Corporate travel. Just bring up my analysis. There we go. Just recently, a little bit difficult to see here, so let me move out my value line out of the way. Let me move the page down a little bit, and if we zoom in we might be able to see this a little bit better along the way. Again, our relative strength comparison going up. Now this came up on scans last year. In terms of our price action, trough at or above second from last peak. Plenty of opportunity as this short-term trend continues up to get into the trade. Managing it just simply by waiting till our 3 ATR line, which is our green one, comes up passing our initial stop, which would be just below our most recent trough outside of 2 ATRs, and being patient. Now if we do that and we get stopped out eventually on this particular end of the week, on the 1st of May, a few weeks back, then we enter a trade at $7.96 and we get out at $10.42, and that represents a 30% increase in 147 days. So that's a pretty nice return just by being in and being patient and letting the market do what the market's going to do. Alternatively, along the way, you had some opportunities where your price volume volatility signal went off. It went off on this particular date. An example there. In 150 days, you've made 55%. Certainly, opportunity there that if you wanted to sell half, you could. So you're making, 55% on half the trade. The other half, you've made 30%. You've got an average of, around about 38, 39% from a trade. And that didn't take that long from your initial entry back in October of last year to a couple of weeks ago. You compare that to what the rest of the market's doing and what mums and dads are trying to do with their Telstras and bank shares and Woolworths, AMP and all those sorts of things. It's a massive difference. So I just really want to make it loud and clear that the scans that you've got here are really pointing you in the right direction. The only thing you've got to do is just trust yourself to follow a simple trade management strategy along the way. Right, so we've had a look at Ramsay Health Care as an example, looking at relative strength, so compared to the broader market. We've also had a look at the internal rate of change, that is what we call absolute relative strength as well. And we've seen that when we can team those two up, the potential that it provides for a stock. It's not a guarantee, but it helps us to look in the right direction. So momentum, just to recap. It's the tendency of investments to persist in their performance. Assets that perform well over a 6 to 12 month period tend to continue to perform well into the future. The momentum effect of Jagadish and Titman in 1993 is one of the strongest and most pervasive financial phenomena, and that's from Gary Antonacki. And I suggest that if you're interested in this type of research, there's plenty on Investopedia. As an example, lots of papers that have been written about momentum and its impact, and it's certainly something that I think you should all consider when you're looking at stocks and what stocks to put into your portfolio. So just a quick recap what we've discussed today: ripples, waves and tides. So short-term relative strength comparison, so comparing the stock, how is it performing to the shorter term moving averages of the benchmark. The waves, how does it compare to the medium term trend, if you like, or strength of the index, and the tide being the longer term. Momentum and relative strength, certainly when combined together, are very, very powerful and something that you should all consider. Beyond charts, it really does help you because you've got a tool there with those scans that help you to look in the right direction. Okay, you've just then got to have a little bit of experience, a little bit of your education to understand price action and how you choose to structure your trades so you know what the risks are, and then just be patient. Let that momentum and the relative strength carry your stocks in the appropriate direction. Okay, so think about what's happening, not just to your stock, think about what the market is doing with your stock and why might that be. Why is it that your stock is being bid up higher and higher? Why is it that tide is continuing? There must be something behind it in the background that makes that stock a valuable entity and the market is pursuing it. Keep your trade management simple. Stick with your trailing stop as an example or a suggestion of a very easy to use method for trade management that's going to keep you in your trades for as long a time as the market thinks that your stock is still good. And that can, as we've seen in Ramsay's case and a number of other stocks, CSL, Flight Centre, G8 Education, MTU, can go on for quite a long period of time. Well, that's it for this week, folks. I hope that's provided useful and gets you thinking a little bit about the importance of your scans and what they present for you. Best of luck with your trading, and hope to catch up with you on the next Monday morning session for the weekly analysis session. Thanks, guys.